Hello, good afternoon, and welcome to the Investment Strategy Outlook for 2023. I want to say a very big thank you for making out time from your very busy schedule to be a part of this conversation. And, just to give us an insight before we go into the crux of today's main event, we know that for the most part of 2022, the world has been going through a lot of challenges. Growth has been tepid, inflation has been high generally, and the Russian-Ukraine crisis has hit almost everybody. And on the back of that is where we are bringing this strategy outlook for 2023, titling it Soft or Hard Landing. And with me on this call, I have my colleagues that will be running us through the entire presentation. But before we continue, I would love to introduce the Managing Director of Afrinvest Asset Management Limited, Chris Omo, to just say hi and welcome us before we continue. Hello, Chris. Good afternoon.
Hi, Victoria. Thank you for the introduction. I want to appreciate everyone for taking time to attend this presentation today. Like Victoria said, the title is Hard or Soft or Hard Landing. And this event, this edition of the Investment Playbook is targeted at helping investors, all category of investors, make informed investment decision in 2023. And I know that at the end of this presentation, some of us will have a lot to take back and strategize on how we can tailor our investment in 2023. Thank you all for joining. I'll be handing over to Victoria to take over. Thank you.
All right, thank you very much, Chris, and thank you for honoring us with your presence. Without further ado, on this call with me, I have Temitope Omosuyi, who is the Investment Strategy Manager, Babajide Atolagbe, who is Portfolio Manager, Raymond Okpara, who is a Fund Analyst, and Robert Omotunde, who is the Chief Investment Officer here at Afrinvest Asset Management Limited. And the flow of the entire presentation, we are going to be starting with the global and domestic macro economic review and outlook, and then we'll move to the global markets and domestic market review and outlook before we go into the crux of why we're all here, investment strategy outlook, and how we think you should, position your portfolio for 2023. So, Temitope, over to you for the global and domestic macroeconomic review and outlook.
All right, Victoria, thank you very much for that wonderful introduction. So let's just hit the ground running on global macroeconomic event for 2022 and what we think would shape the economy in 2023. We'll also replicate this for the domestic economy. So I mean the Nigerian economy. So now let's start with the three major events that caught our attention this year. One, the COVID-19 that has been relegated to the back foot. Two, inflation. And the third one will be the Russia-Ukraine crisis, even though we know that that is actually on the front burner. So starting with the COVID-19 condition, even though it has decelerated strongly in terms of the new cases, but it's quite clear that we saw a bit of spike this year, particularly in February, because of the outbreak of the Omicron variant of the virus. At the same time, we also saw a bit of spike in June, July, owing to, some concern in China. So all of this is showing that, yes, there's still COVID-19, but it has been relegated to the back foot. Why this is consequential to global economies? Because, there's a zero COVID policy in China. And we know that once there's a problem in China, an economy that accounts for close to 19% of global economy, we know that it has a grave, and serious implication on global economy. So we know that it affects commodity prices and a number of other, indicators. So, and it's quite sad to also know that it has claimed over 6 million lives and about, over 600 million people have contracted the virus. So now moving on to the second important issue that took our attention this year Russia, crisis is on the front burner as well. It has actually displaced over 7 million people, and as a result of this war as well, as a result of the war, about 5,000 people have died. And what is even more important was the fact that the Russian government came up with some referendum to harness some portion of Ukraine, but this was actually largely rejected. And moving on to the third event, which has to do with inflation. Inflation has affected everyone. No economy is, left untouched. And the major drivers include, soaring energy prices and food prices. We also look at consumer insecurities. What we mean by that is because consumers are fearful that prices will go up, so they began to front load. So the apprehension also took a toll on commodity prices. And in terms of the impact of fiscal and monetary policy, so the spillover effect of what happened in 2020 and 2021 in terms of the synchronized fiscal and monetary policy support also took a toll, on inflation, and we're looking at over 8% for this year, and we think that there could be a bit of deceleration. And now looking at policy response, central bank could not just look at inflation and not take a stance. So we've seen a lot of policy changes across countries, particularly the US, and even in Nigeria. We've seen about 500 bips increase in policy rate from 11.5 to about 16%, apart from Turkey and China, where inflation, despite the fact that they are a bit, reluctant to increase policy rates, inflation is still as high as 80% in Turkey, while for China is still quite mute. And if you look at all of this, it has one impact beyond other, major impact. It has a major impact on growth. For instance, this year we think that global economy growth will slow down from 6% last year to 3% this year, and for next year we think that yes, growth will slow down, and the major drivers are largely advanced economies, Euro area. But for SSA countries, even though yes, growth will slow down this year, we expect that those economies will remain relatively stable next year because they are not as susceptible to the current, drivers of global economy or shocks compared to advanced economy, because most of these economies are they depend on agriculture that are, that are gotten locally. So we think that they are not as responsive to exogenous factors, supply chain bottleneck, and other factors like like the advanced economies. So moving on to how trade, because trade is an essential, component of GDP. So looking at how trading activities has fared on the back of this macro uncertainty we have discussed, from inflation to interest rate, we observe that, this year, trading activities in terms of global trade, movement of goods and all that have decelerated, substantially. We are looking at about 3.5% for this year. And next, we also think that growth in terms of, trading activity will also slow down in 2023. And the reasons are not far-fetched. Once there's increase in inflation, we know that it will impact global consumption, and that will affect, trading activities, because if there's no demand, there won't be import or export. And we cannot even forget the impact of, the supply chain bottleneck that was actually disrupted as a result of the COVID-19 pandemic and what has happened during the Russia-Ukraine crisis, because a number of major logistic companies were sanctioned, and all of these companies have not gotten back to business. So it definitely continues to take a toll on global trade growth. And in terms of fund flow, every country needs fund to develop, from capital, from portfolio investment, foreign direct investment, in fact, in form of debt or equity. So, but you observe that, for major economies, particularly advanced economies, even though we've seen a lot of fluctuation, right? But the fluctuation in frontiers economies is quite conspicuous, very obvious, because these economies grapple with different challenges, that are quite, significant or more than advanced economies. For instance, a number of these countries grapple with, fiscal challenges, vulnerability of their fiscal condition, their sustainability got worse, inflation at the highest level, a currency problem. So all of this led to capital reversal. And more importantly, as a result of increase in interest rates in advanced economies and the heightened, uncertainty around the financial market, we saw capital reversal, we saw capital outflow, and that was quite evident even in the Nigerian market. So moving on to the general outlook, we think that this year, growth will end up lower than last year. But for next year, for 2023, we think that growth will slow down substantially. And the lag impact, we know that, a lot of policy has been taken this year, but the impact will become quite evident next year. For instance, we understand the lag impact of increase in interest rates. So next year, we begin to see much of those impacts affecting, commodity prices. We also think that next year, inflation will moderate, and thankfully, base effect will support. That does not mean prices will plunge significantly, but because of the high base effect, inflation is expected to decelerate. And are we looking at another recession? Maybe less likely, because if you look at labor market, it's quite strong, particularly in the US. Labor market is still at the lowest level in 40 years, 3.7%. And major leading indicators are suggesting that the economy is still quite strong, despite over 300 bips increase in policy rates. And if you look at policy tightening as well, it seems the Monetary Policy Authority is recognizing that there's a lag effect to all of this, and so there's going to be limited room for policy rate hike next year, because they don't actually want to impair the economy as a result of with the expectation of reining in on inflation. So that brings me to the end of the global macro review and outlook. So I'll be taking us through what has happened in the Nigerian economy in terms of the numbers, and provide insight into what we expect in 2023. So for the Nigerian economy, what comes to our mind is how the GDP is faring. In terms of GDP growth, you observe that yes, it has stayed afloat after the recession of 2020, but the trajectory of growth after the first quarter of 2022 is quite disturbing. We saw 3.6. The second quarter of this year we saw 3.4, and we saw 2.2. So the growth outlook is becoming disturbing because of a major sector that is suppressing growth. The oil sector. Oil sector, has declined, has been in recession since 2020, and this is quite disturbing because Nigeria is no longer having a balanced growth. So which means if we had seen a positive performance in the oil sector, maybe by now we should have been talking about over 5-6% growth. And even the non-oil sector is grappling with a lot of challenges. Look at what is happening to industrial sector, agricultural sector, the challenges around the security, and a number of factors. So moving on to inflation. It's quite obvious that price pressure is still there. A lot of us are grappling with how prices have surged significantly, and long-term inflation on the back of this, that is 10-year inflation average, has surged significantly from 10.7% to 12.9%. And we know that this will continue to affect pricing, of financial assets and other asset classes that are linked to interest rates or inflation. So we think that there's no respite in sight, in terms of a major drop to inflation. All right, so I'll be taking us through how this has impacted Nigeria's fiscal condition. The fiscal sustainability condition has also deteriorated. For instance, if you look at government deficit, that is expenditure, the difference between government expenditure and revenue, it has even worsened. For instance, in 2020, it was just 6 trillion, and now we are looking at over 8 trillion for this year, on a pro rata basis, which shows that, government will continue to struggle in terms of meeting, needs of the economy. And on the back of that, we've seen significant increase in debt stock, and expectedly, because once there's deficit, government has to finance, and one of the major sources of finance is debt. And you see that from 2016, when debt stock was just barely 20 trillion, it has increased substantially to over 40 trillion. And in terms of debt service to revenue, it has also moved up significantly. And when you look at the 2023 budget as well, it's also very, very disturbing. We are looking at expenditure of over 20 trillion and revenue is barely 10 trillion, which means the fiscal deficit is huge, and government is going to come into the market heavily, debt market, which means the debt stock you are seeing here, by 2023, you should expect, higher debt stock, and this has implication for the overall economy. All of this we'll discuss in subsequent, slides. All right, looking at what is happening in terms of policy direction, we know that a lot of monetary policy authorities have increased rates. Some of them is not really to address inflation because they have a very weak monetary policy transmission mechanism. But we observe that the monetary policy authority for Nigeria, the MPC has actually increased rate this year by about 500 bips from 11.5% to 16.5% in a bid to rein in inflation. But on the flip side, we have seen increase in money supply, so that has waning the impact of this increase in policy rates. And when you look at the FX market as well, we've seen a lot of divergence. That the divergence was barely 100 in 2020, but this has increased substantially to over 300. So this is actually very concerning. And for the fact that, you know, foreign reserve is also decelerating, it speaks a lot to the condition of Nigerian external sector. And one could actually link the performance of foreign reserve to the capital importation, so which I'll be discussing it. So on the capital importation part, we've seen, you know, a major deceleration from over 24 billion in 2019 to less than, you know, to about 6 billion. To about 6 billion. Right. So capital importation has actually decelerated to about, you know, 6 billion in 2021, and we are expecting that, you know, by this year it will close at about 6.2 billion. This was what we used to receive in just one quarter in 2019. All of these have dovetailed into what we are seeing in terms of the foreign reserve. But when you look at foreign trade statistics, it's quite, you know, impressive, because currently the trade balance, that is the difference between import and export, is quite positive, from about, you know, about 200 over 200 million last year. Now we have it in the positive territory, over 2 trillion naira. So one could actually link the positive performance of the trade balance to two factors, among others. One is the depreciation of the exchange rate, because this number is reported in naira, so it automatically benefits the trade balance report. And secondly, we could also look at increase in oil price. So all of those factors have contributed, you know, substantially to the condition of trade balance. So moving on to the political condition, we have, you know, exhausted the macro condition. We think that, you know, for next year, we look at, you know, political parties, the top three political parties, that is APC, the Labour Party, and PDP, and we look at, in terms of the state that will get a minimum of 25% of the total vote. So we observe that all the political parties would have, you know, about 26 states, particularly for APC, 27 for Labour Party, and 28 for PDP. And this could mean that the election will be too close to a call, because these political parties could have, you know, about 25%. And, you know, the trajectory of the political system in Nigeria is changing substantially. And that brings me to another important survey that we have seen out there. A number of us are familiar with them. One of it is the NOI polls that actually survey people with voters card. So the question was that they were asked if they will be they were asked about the political party they will be interested in if they were to join one. So most of these respondents, particularly about 13% of them, said they would be interested in PDP, APC 8%, all the way down to NNPP. While on the other hand, the Anna Foundation that went viral as well, the people were asked precise questions on who they will be voted for. They will be voting for in the election of 2023, that is the general election. About 21% of the responded said they will be voting for Labour Party, followed by APC and PDP. But we have our take regardless of this survey, and one of it is that we can see that the structure of the Nigerian political system and the election system is changing. Before now, no one was talking about Labour Party, but we have this party in as a major contender. And secondly, we think that, well, this survey was conducted largely online. That could actually tilt the results. But more importantly, if you look at the undisclosed, the percentage of people that didn't disclose the political party they want to join, and the number of people that didn't disclose who they'll be voting for, or the political party they'll be voting for in 2023, it could sway the result significantly in favor of any or one of these political parties. So we think that the election will be keenly contested. So, but what is even very important right now, are the objectives or the goals of these three major contenders. If you look at the APC and PDP and the Labour Party, we are quite happy that all these contenders are market friendly, because in terms of they are also pro-growth, because one of the objective or one of the strategies we have promoted, we have consistently promoted in Nigeria, is that we need a president that is pro-growth, pro-market, and we reduce wastages that have resulted from, from inefficient allocation of resources through subsidy and a number of other measures. So that ends our thoughts on the policies for 2023. So I would like to take our outlook for 2023 when it comes to inflation, exchange rates, all the way down to the politicking we are expecting. So for inflation, think that it will stay elevated, and we've also been talking about subsidy removal for 2023. That could change the trajectory of inflation. We know that yes, there could be a bit of deceleration in the first 6 months, but the subsidy removal could change the trajectory. Nonetheless, inflation is expected to stay elevated. So the deceleration is not expected to take it below, say, 15 or 14%. And on exchange rate, we think that the pressure will subsist, because if you look at the trajectory of foreign reserves and what is happening globally in terms of, how inflation will moderate faster in advanced economy compared to Nigeria, exchange rate is expected to stay higher. For interest rates direction in terms of monetary policy outlook, we think that yes, the MPC will take a step further in rate hike, although the pace will slow down. In fact, they may not do much of rate hike in 2023. For real GDP, we think economic growth will slow down because the existing factors that have impeded growth are still there, from insecurity to a lack of adequate infrastructure. So all of those factors are still there. And the other point has to do with the fiscal policy metrics. I've mentioned earlier that the fiscal deficit has widened, so all of this will continue to impair fiscal policy direction in 2023. And lastly, we know that the politicking will have a substantial impact on Nigeria economy going forward. But what is more interesting to us is the fact that the three major contenders, which that one of them will become our president come next year, the three major contenders are largely market friendly. So that brings me to the end of the macro review for both global and domestic scene.
Thank you very much, Temitope. Thank you. Insightful as always. Ground rules, please. If you have questions, please use the Q&A box so that we can get the questions at the end of the conversation. And I'll be moving on to the next slide, which is global market review and outlook, which will be taken by Babajide. So Babajide, I've heard a lot of economic slowdown while Temitope was talking. I've also heard a lot of policy impact for 2023. Do you think it's the same for the global market also?
Well, Victoria, for the global financial market, right, we've had quite the roller coaster year, right, in that space. And we had anticipated it, but not at this magnitude, right? Of course, we understood the fact that we were coming from 2021, where asset prices were, overly priced, in our opinion, given the fact that we had excess liquidity in the system, and then investors had a lot of room to speculate on risk assets. So in 2022, we had anticipated a slowdown, right? And then we also understood the fact that policy normalization would kick in, and then that would, in turn affect the return on risky assets. So that actually came to play, as you would see in my subsequent, discussion. For the global equity space, you could see the trend shows a downward trend, across the year from 2021 December till date. You can see that we've actually, trended on the negative part, right? And that is, across the developed market, the emerging market, and the frontier market. And of course, the major factors, around the repricing, were stemming from the supply constraints as a result of the spillover from the pandemic, right? Also, structural changes in the labor market, which has actually pressured higher wages in the system that has affected margins of these businesses. Also, expensive input prices as a result of the price shocks from the Russia-Ukraine crisis. And also, last but not the least, policy normalization, which also saw borrowing cost pretty much high for corporate, and that actually affected margins. So all this sentiment actually pressured how investors price equities for 2022. And towards the end of the year, we saw some bit of repricing as that particular quarter tested for rebound, and that was because inflation started to slow down in major economies, and then the central banks were looking at how they could moderate the pace at which they will raise rate in 2023. So all those parts of sentiment and dominated equity for 2022. As you can see, it's not an interesting year that investors would obviously want to remember. For fixed income as well, I mean, for fixed income, the major, sentiment in that space was largely stemming from, higher inflation. So we saw that inflation trended higher as a result of, the Russia-Ukraine crisis. What about price shocks, supply demand imbalance, and all of those, technical challenges that it brought to the economy. So energy prices trending higher, food prices started trending higher, and then overall core and headline inflation trended northward. So as a result, central banks started to hike rates in order to curb or fight inflation. So the more central banks started to hike rates, we began to saw developed market, emerging market, and even frontier market. The yields in the fixed income market were hitting the roof, right? And it was across board. Inflation and rate hikes dominated that space. Also, for the emerging markets, we observed that debt sustainability risk and credit risk also pressured sell-offs in that space. And in 2023, we expect that given the fact that we're likely to see some level of slowdown in the economy, which suggests that we might have a recession, which is still likely. The monetary disposition of central banks will be somewhat calm, right? And then we'll begin to see some rooms again in the equities and the fixed income market. We might begin to see people beginning to take position, and then the pricing will be positive for the market in 2023. For the currency market, right? It's been a very terrible year for European currencies. The dollar index has actually outperformed all other corresponding currencies, and that is simply because of the impact of the infrastructure bill, which supported price rally on the DXY. Also, the fact that policy normalization was around the corner, it made it more difficult to access dollar, and also the deteriorating economic conditions of corresponding economies in Europe, which saw their export position pretty much weakened. So the dollar actually outperformed other major currencies. However, there are some outliers. You had Russian ruble, Brazilian rubles, and we know that currencies that are largely backed by solid commodities, actually performed better in 2022 when compared to other non-high yield currencies. So that particular picture was what dominated all through. However, in 2023, we think that the DXY may actually reprice lower, and the gains are likely going to be short-lived because these economies are likely going to come back to their previous economic position, and then of course investors will definitely take profit and begin to see the pricing setting in that market in the short term. For commodities, the energy sector really enjoyed premium demand, right? At the early part of 2022. While most of the price appreciation we've seen in that space were largely driven by supply shocks, right? The Russia-Ukraine crisis, like Temitope mentioned, also positively affected the market, and you can see it is all green for energy commodities. For precious metals, a stronger dollar really affected that space, and investors really investors began to price the impact of China and the slowdown in China on precious metals like copper and iron ore. So you can see that the sell-off was felt in that particular region. For agricultural commodities, it was largely driven by speculations on whether demand going to be high enough in 2022. What are the supply shocks we expect in 2022? But by and large, it was a mixed performance in that space, and we expect that trend to continue in 2023. In that same pattern. For digital assets, right? This particular market has an history of having serious volatility, right? For speaking to Bitcoin in particular, at the beginning of the year, I think we recorded about $62,000 per Bitcoin, right? And then it dropped to about 16,000 there about a month ago. And we understand that the general investment theme is actually weak. We also know that Bitcoin itself, right, cryptocurrency itself had some, crypto-specific issues that had to do with the failure of some exchanges, fraudulent activities, and just activities that basically, dented trust in that particular area. So you saw prices, navigate towards the lowest part of the chart, right, as you can see, and we've actually been at that level over the last 3 months. So we expect that in the coming year, as global macro sentiment continues to improve slightly, we might see interest again in this market. However, we believe that it will be limited given the history of the fraudulent activities and then the failure of exchanges that we've seen in 2022. Last but not the least is the global real estate market. That market has also suffered materially, and that was largely on the back of higher interest rates, which brought about higher borrowing costs in developed markets. And as a result, investors found it very difficult to access liquidity to speculate in the real estate space. So that affected pricing. Also, we also reckon that China had some crisis in the real estate sector, which has been in the headline for quite a number of months now, and the pictures are not looking so great. And that sentiment from China also, filtered into the global real estate, pricing, and then prices are really not in a great position compared to what we had in 2021. In 2022, we believe that as the economy, head towards some level of slowdown, we begin to see central bankers and fiscal authority, dispose some level of support to the economy, right? In times of recession, we begin to see these guys roll out, policies, roll out, policies that could support the economy to a very large extent. So once all those policies begin to enter the market, most of all the sell-offs we've seen across equities, fixed income, real estate, and even to a very large extent, cryptocurrency may be revived, and we begin to see joy in the market again in 2023. However, it is worthy of note that most of the repricing, right, in the market would happen in the second half of 2023. Victoria, thank you.
Thank you, Babajide. So I'll just hand over to Raymond to take us quickly through the domestic market review and outlook. Raymond, over to you.
Okay, thank you so much, Victoria, for this. Okay, for the Nigerian equities market, 2022 has been a volatile but decent outing for the equities market. During the year, we've seen the equities market track as high as 21%, and also floor 3% levels, even as recent as October 2022. And as of yesterday, the all-share index posted a 13% year-to-date performance, and this, highlights the volatility I earlier alluded to. The reasons for this volatility are not far-fetched, and although the global macroeconomic picture, should translate to some risk averseness, as we've seen in other global equities markets, we've seen that the local equity market has begged to differ. We've seen buy interest across bellwether stocks, particularly stocks in the telecommunications and the oil and gas sector, and we've also seen subsequent profit taking, and these movements have guided, the performance of the market. And generally, for the oil and gas sector, we could attribute these gains to the oil price gains we've seen throughout the year, the oil price gains on the back of geopolitical tensions rising, and also demand destructions we've seen, across China. But all in all, we've noted that the Nigerian equities market has been rather competitive. If compared to its peers and even global markets, we've seen that Nigerian market has posted, reasonable gains, in comparison to its peers. But going into 2023, we've highlighted 4 factors, that could guide investor sentiment in playing in this space. Firstly, the macroeconomic conditions. So for 2023, we believe that the rising inflation pressures and also scarcity of foreign exchange and similarly structural changes could hurt, the margins of listed companies in 2023. Also, the yield environment is of note. We expect that the lower yields that 2023 is an election year, and we understand that 2023 is an election year, and we understand how businesses will be looking to this new policy, this new government change, this new policy change to actually implement and strategize going into the year. We understand how each member could affect market decisions and also, corporate stances in that front. And for corporate earnings, we also believe that, although the market uncertainties are largely tilted to the downside, as we expect a moderation in inflation, to improve corporate earnings for 2023. So for the fixed income market coming into 2023, we expected a surge in yields, I mean, on the back of a number of factors. Firstly, and most importantly, inflation. From the most recent data we got from the Nigerian Bureau of Statistics, inflation is currently at 21.09%. I'm also seeing that subsequent efforts by the MPC to rein in this red hot inflation. I mean, throughout the year, the MPC has raised rates by 500 basis points to tame the inflation, but we have not seen this correspondent effect in the fixed income market. I mean, the arguments could be lag effect, but also we also believe that some market yield management is also taking place. But all in all, we've seen that throughout the year, investors have been apprehensive towards the short end of the curve. We've seen that, for example, on the T-bill space, 91-day from 2.5% in 2021, we've seen it go up threefold as of Q3 2022. And also in the bond space, we've seen investors, we've seen that sentiment, that sell-off pressure. We've seen how it has intensified at the short end of the curve. So for us, we try to model, our expectation for yield movements in 2023. We took on the demand side and the supply side, and tried to paint a picture to how yields will move in 2023. So we attempted. So for that, we just use some select bonds and money market instruments, and our model suggests that we expect excess of demand over supply to drive yields lower in Q1 2020 up until April. When we see liquidity thin out to close the year, I mean, we expect generally that yields will be trend lower in 2023, and we have highlighted 4 factors that could further guide, this yield movements in 2023. So, firstly, inflation. So, for 2023, we believe that we understand that inflation is still red hot, but we believe that there will be some moderation in 2023, and this could give a breather, to the elevated, yield levels we've seen in 2022. Also, secondly, budget financing concerns. We see the need to increase domestic borrowing to finance the budget deficits, and that's that room now. We see that limited room for external borrowing, and this could also affect yield pricing in this market. Also, monetary policy guidance. As I earlier noted, the MPC has raised rates 500 basis points this year, and we expect that towards the tail end as we go into 2023, there will be some strategy, even given how global market players are also looking at how, inflation is going, and, the extent and magnitude of their rate hikes. And we believe that if, the MPC or CBN, reduce this rate hikes, you understand the effect it has on the market and in the short term and the long term. And also the main factor, political risk. So we've seen how the electoral activities can affect the yield movements. You've seen how foreign investors, are looking towards, our new government, the new face of Nigeria to guide Nigeria, and this has just kept, foreign investors on the sideline. We believe that as we go into 2023, results from the election would greatly affect, yield movements across the local fixed income space. Thank you.
Thank you very much, Raymond. So far, we've heard how 2022 has fared, or how it has fared up until now. Now we have gotten to the crux of why we are all here, the investment strategy outlook for 2023, and how we think your portfolio should be positioned to properly optimize everything that is coming. And no other person to handle this than our CIO, Robert Omotunde. Good afternoon, Robert.
Good afternoon, Victoria. Thank you so very much. And thank you to Temitope Babajide and Raymond, who have all made my work easier, reviewing all of the macroeconomic developments as well as market reaction so far in 2022. And, we chose this title, Soft or Hard Landing, having looked at the developments in 2022. Remember when we presented our 2022 outlook, one of the things we did not envisage was the Russian invasion of Ukraine. And that singular development actually changed the global macroeconomy and market reaction, which today the global economy is still grappling with. One of the consequences of that invasion was the great inflation phenomenon, which dominated most of the economies all over the world, from the developed economies, and the ripple effect, or what we could call the contagion effect, felt within most sub-Saharan developing economies all over the world. Now, so what we are seeing is a rise to meeting what to stabilize the economy across board. By that, I mean global systemic central banks have had to come up with tightening policies from US Fed to Bank of England to, Bank of Japan, ECB, to all the developing economies, even emerging markets. All of the central banks are, running the tightening course. And the implication of this has been the changes in asset prices, so much so that we are talking about the implication of these to the global economy as a whole. Remember that after we came off the slowdown in the pandemic, we have seen some sort of recovery that the economies recorded in 2021. 2022 was supposed to continue that recovery, but of course, inflation phenomenon, which aggravated energy prices across board, impacted a great deal on developed economies, general price levels. And then the implication was that because, of course, energy is very significant, it's core to most economies across the globe. And that's the impact we have seen so far in the year. So we've seen inflation leading to high interest rate environment. The last time we saw the US yield at this level was over 2 decades ago. We are seeing very significant hikes in interest rates across developed economies. This, of course, has made most developed economies more attractive for capital flows. And the implication has been that there has been this reversal in the emerging economies, and of course, frontier economies as well. So high inflation leading to high interest rates, which is now bringing up the possible consequence of slowdown in the economy, and of course, which can also lead to high unemployment. So when we conceptualize this title, we're looking at some of the events that have played out in the year. Are they going to be on the ground of soft landing or hard landing? Of course, what we refer to as soft landing are issues relating to how the economies react to some of these developments. And of course, from a hard landing point of view, do we see a situation where inflation further aggravates, and then most systemic central banks have to continue the course of tightening? In the course of this presentation, which I'm going to try to do within the next 5 to 7 minutes, we are able to dissect it more critically. From a geopolitical point of view, and Russia's invasion of Ukraine, we look at hard landing from the possible aggravation in terms of how the war is panning out between Russia and then Ukraine. The possibility that there could be a physical involvement of NATO, which is one of the things that if you follow the politics, NATO has been trying to avoid in order not to upset Russia, because this could have consequence. It could actually as well lead to another world war, which most economies are trying to avoid at this point in time. Do we foresee a possible expansion of NATO into the some of these territories that could really worsen the tension which the economy already faces? Do we have a prolonged period of sanctions and restrictions, which are, of course, the reasons why we are seeing inflation at this level? And let's be clear that what has happened to global economy so far this year has been dictated by the movement in general price level across the US, European economies, and emerging, of course, frontier markets. It's the biggest thing that everyone has affected the global market this year. From a soft landing point of view, we think that extension of the current peace talks, and ceasefire arrangement could give us a soft landing as we go into 2023. If we see a situation where, Ukraine's intention, to join NATO is kind of cancelled, the demand for that subsided, that could be some sort of soft landing. If we see prolonged economic crisis, in Russia, maybe it could, get Russia to backtrack. It could be some form of soft landing. And finally, domestic political reforms within Moscow. Now, if you look at all of these issues together with what I have discussed, then the other question to ask will be that will inflation aggravate as we go into 2023. Already we are seeing the signs. It's most likely that most central banks will target a slowdown, maybe not a complete reversal of the trend, but we are likely to see a slowdown. And if you look at the data that we're reading across, if you look at the US market, for example, we are beginning to see, slowdown in inflation figures on the back of the aggressive tightening of the US Fed. And in 2023, there's a target of about 2.8% in terms of the increase that we will see in Fed fund rates. And if you look at some of the projections from JP Morgan to Goldman Sachs to Bank of America, on another OECD countries, we are looking at a possible moderation in terms of the pace of tightening looking into 2023. And of course, when you look at market sell-offs across board based on data that was sampled by the Bloomberg, and we are looking at the rate or the pace of default, and you look at countries that were sampled, it seemed as though El Salvador may be topping that list, followed by Ghana and some other countries, most of which are either within the emerging economies or developing economies, so to speak. And then from a widespread recession point of view into 2023, there is a possibility that given the pace of tightening that we're seeing now, we could see weaker economic growth in 2022. And this is supported by some of the views of most banks that we sampled, banks like the Bank of America, like the IMF, Goldman Sachs, JP Morgan, OECD, and of course, Citi. I mean, if you look at that from a global growth perspective, we expect that there will be some sort of significant slowdown. And moving on, how do we conclude all of these matters, in terms of what we've seen in inflation and how the markets have reacted? It seems to us that we are getting towards a period when it seems like bad news may actually sound good somehow. Yes, inflation is now moderating on the back of aggressive tightening, but from a growth projection point of view, you will see that we are seeing some projections such as from Barclays and BNP Paribas or Bank of America, suggesting that the economy may actually be recording a negative growth into 2023. But is this the likely play out? We think that the economies are going to slow down, no doubt, because we've seen more aggressive tightening and inflation has gone beyond the long run levels that could actually support growth. And from asset class point of view, we think that the market will react differently depending on which asset class you're looking at, whether it's fixed income, equities, currencies, commodities, or alternatives. So in the light of all of these, we have been able to develop our strategies, the strategies that we think will shape most investors' view into 2023. And these perspectives are, driven by the research that has determined the development of inflation. I mean, looking at inflation and growth from that particular perspective, we think that there are things that will guide investors' position in 2023. One of which we preach is a muted downside volatility. What we are saying here essentially is that we've seen the biggest level of volatility in 2022. We think that in 2023, we are likely to see a lot of recovery across asset classes, with the exception of commodities. We think that we will see recovery in fixed income or interest rate normalization. We think that we are going to see recovery even in equities, as investors are going to take advantage of low valuations. So because of that, we think that the volatility will be muted on the downside. If there will be any such huge volatility, we think it will be on the upside for asset recovery. So because of that, timing is very critical to what investors are looking at into 2023. And market timing from here, we cannot overemphasize it, timing the market. And that's why positioning at this point in time may be advisable for investors from a research point of view and what you have been able to deduce. In terms of valuation, we think that there will be a lot of repricing, and that repricing will be to the upside, which is why investors need to, be very timely in taking position. Another theme we are looking at for 2023 is cautious trading. Investors need to be aware of a lot of short trading because they may find themselves getting hit on the other side. So it's important that investors need to be very cautious as we move into 2023. And of course, portfolio rotations on the back of the recovery will most likely, favor a lot of assets. So if you've done your decent return as we go into 2023, it will be advisable to rotate out of, asset classes or securities that are giving you returns and look at other, lagging assets that you can take advantage of. But definitely in 2023, we are convinced that fixed income is going to dominate. So there's a likelihood that those who are invested across fixed income securities, across corporate sovereigns, and across markets are likely to benefit from our strategy point of view into 2023. Moving on, if we look at our strategy in terms of an ideal portfolio of a universe, when you look at that, given all of those themes that we're looking at, we think that fixed income will dominate. So we have allocated about 50% to fixed income in an ideal portfolio that will guide in 2023. We think that real estate still offers a lot of opportunities, not just in the developed market, but even within the local market, given all of the indices that could support development in that space. We think that equities should be invested on a cautious basis. And as a result of that, our allocation to equities will be 15%. But definitely commodities, private equity, and VCs, we will allocate 10% and 5% respectively on the basis of the opportunities that they also offer. Moving on, from a fixed income strategy point of view, since it takes the bulk of our allocation into 2023, we think that investment in sovereign, because of the upside volatility they offer, will be something advisable. Remember, we are preaching that there will be fixed income bias as we try to diversify, and not just that, because we expect low volatility to the downside, more volatility will happen on the upside. So the sovereigns are the ones that offer much volatility on the upside. The corporates, we think that 20% allocation will just be decent. From a short and long end point of view, we think that because we expect yields to moderate, investing across the, towards the long end of the yield curve will be most advisable, hence our application of 65%. But in terms of activity, we think that if you must play more actively in the market, maybe about a half of your portfolio should be tilted towards that. In terms of developed fixed income market, we think that in terms of allocation, US Treasury should also take a huge chunk of that, given that yields are at unprecedented low level as we speak. At high level, as we speak, as prices are extremely very low. And as we look into policy reversal, at the best, maybe at the worst, maybe a muted level of yield, we still expect that US Treasury will present very good opportunity, and the duration play is advised, and that's why you see 60% allocation. Within the other developed markets like euro area and gilt bonds, particularly talking about bonds in the UK, we think that 20% allocation is just decent. Then moving on, when you talk about the sub-Saharan Eurobond space, we are a bit biased towards Nigerian allocation, hence our 65% allocation to Nigeria. You see that it's taking the largest chunk of our allocation in terms of sub-Saharan African deployment. Of course, we have to be guided to invest across the sovereign Eurobonds. Hence, we are looking at both Angola and Kenya as part of the names that we're considering. And of course, corporates should take just about 20%. One way to invest in this asset class is through some of the products that we offer, a direct Eurobonds purchase, which you can achieve for you, or Afrinvest dollar fund, which is targeted at a specific market, particularly Nigeria. In terms of In terms of the talking about the local market, FGM bonds, our strategy will be to average up your yield and wait for repricing. We think that as inflation begins to aggravate, and we don't think inflation will cool off soon in Nigeria because of other pressure points that you're expecting towards mid-year, particularly after the election. So we think that what investors could do now is to continue to average up as yields are rising. And then the time to wait for you to benefit may be up to 2024, but definitely that's one way to benefit. There are direct ways to invest in it, which is direct investment in these, instruments directly through Afrinvest. We can help you to buy your bonds directly, and if you're the type that like to subscribe to a fund, our NIDF is targeted at local bonds market. You can take advantage of that. Moving on, you look at our preaching in terms of short-term money market instruments. We are still very positive about CPs. We know a couple of very quality CPs that have been issued so far in 2022. We look forward to those in 2023 and see how investors can also benefit. And in terms of equity strategy, we have about 4 major areas we are looking at. We think that investors need to invest in defensive stocks because they are likely going to weather the storm. So we identified that by low beta stocks, and the sectors that we have identified across board cuts across utilities, energy, consumer goods. We think that a lot of caution are needed in those areas. Investors can continue to average down as prices go lower to get the best price to look at. And in terms of developed equities market, we have some names that we have researched into that could give investors very good return. And you see our upside potential. I think we have a minimum of about 8.15 and maximum of almost up to 190% in terms of return. So investors can take advantage of this. And on the local front, if you look at our the equities we are looking at from a local point of view, we have some select names as well. We think that cheap valuation and greater upsides are possible with these names that we have selected. Because if you look at the average return we expect, it's over 50% for 2023. Of course, there are direct ways you can invest in these. It could be through our equity fund, or we can help you buy your stocks directly through our brokerage subsidiary. In terms of alternatives, there are 3 major themes we think it shape your investment play into 2023. We think that investors need to stay risk conscious as alternatives tend to come with a lot of risk. We also think that in terms of return expectation, inflation should be your anchor as you look at your alternatives. Of course, shorter investment gestation period are advisable given the risk that comes with alternatives. Commodities, as given a weak dollars, we think that there will be sustained interest in that space. And particularly, we have a product that can help you take advantage of that. And of course, for real estate, we also expect that the market will, present a lot of opportunities for investors to take advantage of going into 2023. We've tried to rush into this presentation because we respect your time and we don't want to take too much of your time. But I think at this point, come to the end of the presentation, and we think that we can take question and answer. So Victoria, over to you. Thank you.
Thank you. Thank you so much, Robert. Thank you, everyone. Very insightful presentation. For everyone asking, yes, as always, we will be sharing this material with you at the end of this presentation. So there's no need to worry, you get this material. For the question here from Salim Achi, and he's saying, based on the outlook for 2023 being an election year, what's your advice in terms of taking position in the equities market?
Well, we think that in 2023, yes, election cycles come every 4 years, and we are aware of this. Again, I don't think that the market will necessarily be apprehensive about the election of 2023. The reason is because even though we have projected that it's going to be a keenly contested election, and we think that there is a possibility that there could even be a runoff. But the truth is we have about 3 major candidates that we identified and we are definitely certain that the next president is coming from, among these three candidates, which is the parties we showed you in the previous slides. But I think the point here is that what strong point that we identified is that from these three major candidates we think are on the front liner, they are all pro-market. And because of that factor, we think that the market is expectant of whoever emerges. And I think that whoever emerges among those three, if there's any concern that the market is looking at, maybe the security implication of the upcoming election, barring that, I think market view is that whoever amongst these three emerges as a president is positive for the market any which way. So our advice will be that you can still position. This is the time to identify cheap stocks, some of which we have already identified for you in this presentation, and you can action them, through our Afrinvest app, which basically trades equities and allows you to do it more seamlessly. And if you have the large volumes, you can also contact us directly. We can get that executed through our broker subsidiary. Thank you. Moving on, Victoria. Victoria, over to you. Okay, I think there may be a bit of connection issues there. So let's see if we have more questions in the house. Yes, we've said that the presentation slides will be made available to us. We will send it through your email addresses that we have. Yes, somebody is asking what are leverage trades. Basically, they are trades that allows you to buy on the back of monies you do not have. So it's more like borrowing to trade. This could happen through any of the asset classes, equity trading, margin lending, as they call it within the equity space. In which case, on the back of, you could, get some, funding to buy into securities that for which you do not have money, and then you pay back with some interest. Perhaps you will have had a view of how you think the market will move, and on the basis of that, you take position. Victoria, over to you. I think you're back.
Okay, I'm just being a bit time conscious because I see we are well past our 1 hour mark. So we are really sorry we couldn't take all questions, but please do well to send all your questions to am@afrinvest.com. am@afrinvest.com. I'll also type that out in the chat box. Do well to send in all your questions, and we will be taking all of them, as many as we can. So I want to say a very big thank you to everybody for taking our time from your very busy schedule to be a part of this conversation. And as always, want to wish you happy holidays. Don't forget to reach out to us for any of your investment questions, or if you want to invest with us. Until next time, take care.